the lesson learned from 2007-8 is that, look, as long as you diligently deploy capital and stick to your knittings and do what you've been taught to do, you can get to the other side. And it may not be a high growth strategy from an assets under management perspective, but it withstands the test of time. And I think if you look at the body of BDCs and other funds out there right now, we're one of the few, I think probably less than 5% that have experience that dates back that far. So, we've been around a while, we've seen it all. And, one of the, selling points for Gladstone is simply that, is like, look, we want to help the businesses grow, right? And we're here to provide growth capital. And fundamentally what we do is we invest in a plan that either management has to grow the business, or a plan that management and the private equity firm is developing or has a thesis around, or one that we're sponsoring. So we're very much focused on sort of a long-term horizon of investing, and that's kind of what it takes when you're dealing with smaller, private, lower middle market companies.
I think what you said is really interesting. There was something you said there that I found particularly interesting as it relates to what you went through in 2008, and that you really got your hands dirty but working with your companies, which is very different than the traditional banking model. Yes, some banks have workout groups or whatever, but I do think one of the benefits of private credit for a business, a small business or otherwise that might have difficulty tapping the banking system, is that private credit teams tend to be willing to go in there and work around and help the company, if it finds itself in a stress situation, find a way to ensure that the company can make through that. Even if in the short term, maybe you don't get paid or you do something like that, but really the focus is ensuring that the company will be able to pay back the debt, even if in the short term it's under stress. Can you talk a little bit about, the advantages of doing that, and why, that can be really helpful to people investing in private credit?
Sure. No, that's a great point. You brought up banks, and I'm a recovering banker, and the challenge with commercial banks is the focus for a long time tended to be around making loans and focusing very much on the collateral, right? And banks are very highly levered, 8, 9, 10 times leverage, and there's very limited capital that you can play around with. Whereas, even LP funds, BDCs certainly have very low leverage, and interval funds have even less leverage. It gives you more cushion and opportunity to work through the downs and get to the other side, as I mentioned. So when we talk about, trying to support a business, whether it's going through a systemic low or a economic bump in the road, all we're really doing is we're reverting to our original thesis and interest in the business, right? Do those key pillars still hold true? And if so, then it's simply a matter of either bringing in additional talent, bringing in additional capital, restructuring the stack in order to get the team to the other side. Whereas when you're talking about banks, and you mentioned workouts, and I used to sit in one of those seats, it's a much different environment. You have to clean the balance sheet, right? And there's a lot of pressure to get rid of those kinds of assets. Whereas as a private credit investor, where we're more focused on the enterprise value and the cash flow generation of the business, as opposed to necessarily the hard collateral that you can liquidate, then it sort of gives you a different view in terms of the world, and as well as the horizon for a business, right? And that's what I would say is kind of the main difference. And I can't overemphasize the fact that you mentioned BDCs are relatively low leverage fund structures versus banks, and even versus some LP fund structures, and certainly compared to CLOs. So that really informs how you're able to sort of go in your toolbox and fix a problem.